Warren Buffett's fortune today exceeds $141 billion, more than the GDP of over 100 countries. But what's truly remarkable isn't just the size of his wealth, it's how he built it. He's been compounding his wealth for over 3/4 of a century. To invest successfully over a lifetime, you don't need an extraordinary IQ or unique business insights. What's truly required is a solid intellectual framework for making decisions and the ability to keep emotions from corroding that framework. In The Intelligent Investor, Benjamin Graham provides exactly what's necessary to build that framework. This book isn't just about making money. It's about developing a mindset for managing money that will serve you well for a lifetime of successful investing. Buffett himself has called it by far the best book on investing ever written, and his success story is proof of the wisdom found within its pages. In this video, we'll dive into the principles and strategies that have made this book a timeless guide for investors worldwide. Let's get started. Imagine there's a guy named Mr. Market who offers you the chance to buy or sell shares at different prices each day. The price at which he offers to transact is always determined by him, but he never forces you to accept any of his offers. Mr. Market is very moody. When he's in a good mood, he sets a price much higher than the true worth of the business. When he's feeling down, he offers them at low prices. In essence, Mr. Market is a hypothetical investor whose behavior is driven by emotion, whether it's greed, fear, or anything in between. As an investor, your job is to take advantage of Mr. Market's emotional swings. Buy when he's pessimistic and offers shares below their true value, and sell when his optimism pushes prices far beyond their intrinsic worth. In the stock market, Mr. Market's emotional cycle closely mirrors the fluctuations we experience in the real world. As investors, we must prepare both financially and psychologically to navigate market fluctuations. It's our responsibility to leverage the liquidity and inherent volatility of the market to our advantage. The prices may fluctuate, but make your move based on fundamental analysis rather than temporary emotional reactions. There are two main approaches an investor might use to profit from these fluctuations. Timing, where you buy when you anticipate the price will go up and sell once it has increased, and pricing, where you buy when the price is below fair value and sell once it reaches or exceeds fair value. Benjamin Graham would argue that pricing, focused on long-term value, is the more reliable and disciplined approach. He believed that attempting to time the market would inevitably turn an investor into a speculator. A speculator's primary goal is to anticipate and profit from market fluctuations, while an investor's primary goal is to acquire and hold suitable securities at appropriate prices. According to Benjamin Graham, there are two distinct types of investors: the defensive investor and the enterprising investor. Defensive investors seek to minimize risk and prefer to spend little time managing their investments. They focus on stable, low-maintenance assets that prioritize safety over high returns. In contrast, the enterprising investors seek high returns and dedicate time to research and analysis. They actively manage their portfolios, selecting stocks and bonds, and consistently search for profitable opportunities. The defensive investor typically maintains a balanced portfolio, often consisting of a 50-50 mix of high-quality stocks and bonds. However, this allocation is flexible and can be adjusted based on your individual financial goals and risk tolerance. For instance, if you're approaching retirement and prioritize stability, you may shift the balance more toward bonds. If you're younger and willing to take on a bit more risk for higher growth potential, you may shift the balance more towards stocks. Being defensive is more likely to lead to average returns rather than alpha or excess returns. However, average returns compounded over the long run are a strategy that Graham suggests we should consider betting on. Here are 5 key metrics that defensive investors prioritize when evaluating stock investments. First, current ratio. The ratio of a company's current assets to liabilities should be strong enough to ensure adequate working capital during tough times. Second, earnings per share. A company's profit divided by number of shares should have been positive for the past 10 years to show a strong management track record for shareholders. Third, P/E ratio. The company's current price divided by its earnings per share should help you determine whether the company is undervalued or overvalued. Fourth, price-to-book ratio. This ratio of price to assets will also help you determine whether the company is currently undervalued or overvalued. Fifth, management. Understanding a company's management, principles, and behavior helps you determine if they're trustworthy stewards or just paying lip service to Wall Street. Starting with these 5 concepts will equip you with the know-how to invest with discipline, not emotion. Your goal should be to identify and invest in a company's stock with a positive margin of safety. That is, one whose intrinsic value is higher than its market value. By focusing on these metrics, defensive investors can build a portfolio that prioritizes stability and long-term growth, ensuring that their investments are well protected and aligned with their financial objectives.